On a December evening in 2008, one of the most respected men on Wall Street sat his two adult sons down in his Manhattan penthouse. Both sons worked at his firm. Both had spent their lives defending his name. He told them the business they'd built their careers on, the fund managing billions for charities, universities, and thousands of families, was, in his words, one big lie. There were no investments. There never had been. For decades, every statement, every trade confirmation, every return, invented. $65 billion existed only on paper. The next morning, his sons turned him in. This is the story of Bernie Madoff, the longest-running lie in financial history. Here's what makes Madoff different from every other fraudster in this series, and it's the key to the whole story. He wasn't an outsider talking his way in, he was the establishment. Bernie Madoff started his firm in 1960 with a few $1,000s saved from lifeguarding and installing sprinkler systems. And the firm he built was, for decades, genuinely important. Madoff was one of the pioneers of electronic trading. His technology helped drag Wall Street out of the paper era. He served as chairman of the NASDAQ stock exchange. Regulators consulted him on market rules. When the SEC needed an expert to explain how trading worked, they called Bernie. Let that sink in. The man running the largest Ponzi scheme in history spent his days advising the government on market integrity. His legitimate trading business occupied the 19th floor of the Lipstick Building in Midtown Manhattan. The fraud lived 2 floors down on the 17th. A floor most employees couldn't access, running on an isolated old computer system staffed by loyalists with modest resumes. 2 floors, 2 businesses, one reputation covering both. Now, here's where Madoff was genuinely brilliant, and it's not where you'd think. Every Ponzi scheme before him made the same mistake, promising spectacular returns. 50%, 100%, numbers that attract greedy people, and greedy people eventually ask questions. Madoff promised roughly 1% a month, 10, 12% a year. Not amazing, just smooth. The market could crash, spike, panic. Madoff's returns barely wobbled. He claimed a strategy called split-strike conversion, complex enough to sound sophisticated, boring enough that people stopped asking. And then, the masterstroke. He made it hard to get in. Madoff didn't chase investors. He turned them away. You needed an introduction from the country club, the charity board, the synagogue. Getting into the fund felt like getting into a private club, and people who fight to get in don't audit the club. Entire communities handed him their savings. Charities, universities, Elie Wiesel's foundation, Steven Spielberg's charity, and feeder funds, professional investment firms, shoveled billions in while collecting fees, asking remarkably few questions about a manager who never explained his edge. The scheme itself required almost no financial genius. Money came in, statements were typed, money going out was paid from money coming in, a calculator and a laser printer. What required genius was the packaging, the reputation, the exclusivity, the boredom. The tragedy of this story is that it was solved 9 years before it ended. In 1999, a Boston quantitative analyst named Harry Markopolos was asked by his bosses to reverse engineer Madoff's strategy so they could copy it. Markopolos ran the numbers and came back with a problem. The returns were mathematically impossible. The options market Madoff claimed to trade in wasn't big enough to handle his supposed positions. The performance line didn't look like any real strategy. It looked like someone drawing a line. Markopolos took his analysis to the SEC in 2000. Nothing. Again in 2001. Nothing. In 2005, he sent them a memo whose title did not leave room for interpretation. It called Madoff's operation the world's largest hedge fund fraud and laid out 29 red flags. The SEC did eventually examine Madoff and found paperwork violations. The agency that Madoff had spent decades advising could not imagine that Bernie, of all people, was the monster. Markopoulos would later tell Congress he'd gift-wrapped the case and delivered it. He was right. Nobody opened the box. A Ponzi scheme has one structural weakness. It dies the moment more money leaves than enters. For 40 years, that never happened. Madoff survived recessions, wars, the dot-com crash, because his investors, believing they were earning steadily, mostly left their money in. Why withdraw from the one fund that never goes down? Then came 2008. The financial system itself was collapsing. That's a story we've already told in this series, and another one is coming. Suddenly, Madoff's investors didn't doubt him. They just needed cash everywhere, all at once. Redemption requests piled up. $7 billion. Madoff had a fraction of that. The smoothest returns on Wall Street were about to bounce. On December 10th, he confessed to his sons. On December 11th, the FBI knocked on his door. Agents asked if there was an innocent explanation. The 70-year-old man in the bathrobe said there wasn't. The numbers came out in layers. On paper, $65 billion across nearly 5,000 accounts. In real money, actual principal that real people had deposited, around $17.5 billion. The difference was pure fiction. Decades of invented profits that thousands of families believed they owned. Retirees discovered they were broke. Charities closed their doors. At least 2 investors took their own lives. Madoff pled guilty to 11 felonies without naming a single accomplice and was sentenced to 150 years. The judge called his crime extraordinarily evil. The family paid its own price. His son Mark, hounded by lawsuits and suspicion despite never being charged, died by suicide on December 11, 2010, 2 years to the day after his father's arrest. His other son, Andrew, died of cancer 4 years later, saying the scandal had killed him too, just more slowly. Ruth Madoff lost her husband, both sons, and her name. Bernie Madoff died in federal prison in April 2021. And here is the strangest ending in this entire series. The victims got most of it back. A court-appointed trustee, Irving Pickard, spent over a decade clawing back money from feeder funds and from investors who had withdrawn more than they put in, recovering more than $14 billion, the overwhelming majority of the real principal. The fictional wealth was gone forever. But the actual cash? Most of it had simply been moved from later victims to earlier ones. The scheme hadn't burned the money, it had just shuffled it for 40 years while skimming a fortune. Every fraud in this series sold something. Enron sold growth. Theranos sold a miracle. FTX sold the future. Madoff sold the rarest product of all, safety. Slow, boring, exclusive safety, the one thing no honest market can guarantee. So here's the uncomfortable takeaway. You can't spot the next Madoff by looking for wild promises. You spot him by looking for perfect ones. In markets, as in life, if the line never wobbles, someone is drawing it by hand. Next, a man who burned $40 billion in plain sight, entirely legally, and walked away a billionaire. The WeWork story. Subscribe.